Okay, so good evening, everybody. And as Simon just said, this presentation, this class is based on something that I learned from a market wizard. And that's not me learning directly from them, but it's reading one of their books. And it's actually one of my favorite books, and that's Pitbull by Marty Schwartz. And the reason that I like his story so much is it is probably a lot of you guys will be able to relate to it. He was a gentleman that tried very, very hard for, 10, 12 years unsuccessfully until he found something that worked for him and something that he identified with. And then from there, obviously, the rest is history. And he went on to be one of Wall Street's greatest day traders. And one of the things, as I said, I'm going to talk to you about in this web class is one of the techniques that he used. And I kind of apply it to my trading. And I found that it really, really helps sort of, remove a lot of the noise that the market gives you and kind of puts you on the right side of the market, which I think is probably half the battle. We all understand what a technical pattern looks like. I think for the most part, we kind of understand what momentum is, but a lot of us can get chopped up from time to time, trying to buy when we should be selling and trying to sell when we should be buying. So I guess a lot of you will be able to identify with that. So in this, let's get the presentation going here. In this presentation, you're going to learn a very effective price action trading strategy that you can literally use from anywhere at any time. So whether you're trading the FX markets, or you're trading the stock markets in the US or China or wherever it is, you can apply this trading technique to those markets, okay? First of all, I'm sure everybody's told you this today, so sorry for just going over the same stuff, but if you want to get the most out of these presentations, it really is the best thing to get rid of all distractions. So that means, don't have your emails open on a separate screen. Don't sit there looking at Instagram or Facebook while you're listening to my dulcet tones in the background. Just kind of give me 30, 40 minutes of your time. I promise you, you will not regret it, okay? So first things first, let's discuss why potentially you aren't making money right now. It could be down to the wrong strategy. And I'm not going to say that it's a strategy that doesn't work. It may just be a strategy that you don't identify with. I listened very briefly to Tim just now talking about the fact that you should use things that you identify with, and he's absolutely right, to be honest with you. If it's something that, that looks good on paper and makes money, but you can't get your head around, you probably won't make money with it, all right? But I'm hoping that what I'm going to show you today is not just a strategy, it's an approach. So ultimately, it's an approach that you can apply to your favorite strategy, and it will improve your results. The next thing that people fail for is being undercapitalized. So really, and when we say undercapitalized, it's not to say that, going back to the 90s where you're trying to trade a stock account with $5,000 or something ridiculous like that. What I'm really probably referring to here is being over leveraged. You're trying to run before you can walk, trying to make more money than your trading account will justify. So yes, you can find brokers with lots and lots of leverage, which is absolutely fine. The key is being able to use this responsibly to be able to make money. The next thing is obviously not having enough time. Now, time is something that we're all kind of blessed with having equal, but I understand that some people will have jobs that will take more of their time than others. And the great thing about the strategy that I'm going to teach you today is it is something that you can utilize even if you have, half an hour a day to be able to apply it to your trading. And then the final one here, and it's not the final one, there are many other reasons that maybe you aren't successful yet, but one of the other big ones is you have the incorrect mindset. And that's something that I think most people probably suffer with at one time or another. And that's ultimately, sort of approaching your trading in the absolute wrong way, making all of the mistakes that we all make. All right. So let's not sit here and pretend that some of us are much better than others because we don't suffer from revenge trading or going in too big after a series of losses or whatever. We all make those mistakes. The secret really is to try and find a way to eliminate those mistakes, or at least keep them to a minimum. At least make sure that when you're making those mistakes, they're not costing you as much as they once were, if that makes any sense. So then that way, when you do hit those winning streaks, which inevitably everybody's going to experience, you're not digging yourself out of a hole. You're moving your account onto, new thresholds and new higher levels, all right? So whilst we're talking about mindset, let's talk about randomness. Now, there's a great book out there called Fooled by Randomness, and it talks about this a little bit. And that's kind of, you know, what we're looking at here is basically making sure that you're not seduced by your own success or your own failure in small sample sizes. So even if you were to, let's say, take 5 winning trades in a row, it doesn't mean that you've cracked the code and suddenly you can over leverage your account and start taking, much bigger trades than you previously were, because suddenly, you can't get a losing trade. Everything that you touch turns to gold. But by the same token, it's not being disheartened by the fact that actually, even if you had 5 or 6 losing trades in a row, it doesn't mean that your strategy is wrong. It doesn't mean that you're doing anything wrong. It's just that that's the way that the markets work. And I've got a picture here of a craps table, a casino. And the reason I did that there on purpose, because we really should approach our trading the way that casinos approach their businesses. Now, the one thing that casinos have is that they understand what their edges are, or what an edge is, okay? And they play out this edge, and they allow the players to sit at the table, and indeed encourage the players to sit at the table long enough to allow their edge to play out, because they understand that if any one person sits down to the table and plays, 5 rolls of the dice, or 5 hands of blackjack, or 3 spins of a roulette wheel, they may be lucky enough to get up and walk away having made money, because that's just the way things work. Even though they have an edge, and in the long run, perhaps they will certainly be able to go on and make money. When you sit there and you look at things in small sample sizes, then really it just comes down to randomness, and it comes down to luck, right? So I could sit down at a roulette table, I could put all of my money on black, spin the wheel once, it could land on black, I could go away, and that would mean that obviously I've won money and I'm a winner. Does that mean that I have an edge in roulette? No, absolutely not. Even though in theory you think red, black, maybe it's a 50-50% chance. No, it's not, because you have the 0 there, the green one as well. So actually what you'll see is, even by playing red, black, the casino still has a very, very tiny edge over you. And what they do is they encourage the people that are playing the game to sit down long enough to see their edge play out. So you'll notice that I don't know if any of you guys go to Vegas or you've been to a casino before, but what you'll notice, particularly in places like Vegas, is that whilst you're sat at a table and you're betting, they will bring you free drinks, free food. They will bring you everything that they need to make sure that you don't get up and you don't walk away. Because the longer you sit there, the more of a chance their edge has to play out, and the more money that they're going to make. They understand if you sit there for 3 or 4 hands and get up and walk away, then it's kind of down to luck and randomness, and really you could walk away making money. And they don't want that. They want you to sit there for as long as possible. And that's the way that we need to look at our trading. So when you're trading any particular strategy, you don't sit there and think, I've taken 5 trades in a row and, I'm net profitable, therefore my trading system is fantastic, I can increase my position sizes, etc. And by the same token, you don't sit there and think, I've taken 3 losses in a row, therefore my trading system doesn't work, and I need to go and find the next latest and greatest system. Because even if your strategy has, a 70% win rate, there is absolutely no way of knowing what your distribution of wins to losses is going to be, or what the sequence of wins to losses is going to be. It may be that you have, you take 10 trades in a row and you experience 10 losses. Wait a minute, 10 losses? I thought you just had to have a 70% win rate. Yes, you do. You have a 70% win rate, but that doesn't necessarily play out over the course of 10 trades. You might need to take 20 trades or 30 trades or 50 trades or 100 trades to see that edge play out. And that's something as traders, if you learn anything or take anything away from today, this is what you really have to understand. Because I will grant you that perhaps 60% of trading systems out there are profitable. But for the most part, the people operating them, the people that are trading them, won't allow that trading system enough time to play out to be able to see that profitability. And whilst they're taking losses, they'll be tinkering with the system, they'll be making mistakes, and they'll kind of just be digging themselves a bigger hole for them to have to get out when they eventually hit that winning streak. And this is demonstrated by no better way but from actually flipping a coin. Has anybody out there ever gone through a process where they flipped a coin? They've gone heads or tails, heads or tails. Now they've done that over the course of, 10 coin flips, and they've found that somehow they've had maybe 8 out of 10 of those coin flips have turned up heads, 2 of them have turned up tails. I wonder if any of you guys out there have done that. Well, I have. And what I've also done is I've also gone through an exercise of flipping the coin 20 times, 100 times, 200 times, 500 times. And I've seen the way that the win-loss ratio, the heads-tail distribution, starts to even itself out. So if I was to take, 500 coin flips, okay, and I was to take any 10 coin flips in isolation, so, 20 to 30 or 80 to 90 or 105 to 115, I would have a pretty good chance of having those 10 coin flips and maybe 10 of them, or 10 out of 10 being heads or 10 out of 10 being tails, or certainly it being quite heavily distributed on one or the other, as opposed to being an even distribution between heads and tails. However, the larger the sample size that I get, so as I go from 10 to 20, as I go from 10 to 30 or 10 to 40 or 105 to 155, I'm going to start to see the 50-50 nature of the coin flip start to play out. And that's how our trading works. And that's what I really want you to get your heads around, okay? So before we look at the strategy or anything like that, really kind of just nail this down and understand it, because I promise you, I swear to you, this is the most important lesson. Once you have this down, then you can be successful with most of the trading strategies out there. If you don't have this down, then even the very greatest, the very best trading strategy out there will probably lose you money. All right. Okay. So now that you understand that, let's talk about this strategy. And I call it the power of 10. It's a momentum-based trading strategy that puts you on the right side of the markets. Now, where did I get this strategy? Well, as I said to you before, I read a book. It's called Pitbull. It's by Marty Schwartz, and he talks about, his journey and his process towards becoming a successful trader. He talks about how he spent 10 years as a Wall Street analyst, okay, trading in his spare time, not really kind of taking it seriously, applying fundamentals to his trading and not really applying technicals. And let me caveat this by saying that I'm not saying that fundamentals is worse than technicals or technicals is much better than fundamentals. I'm not even saying that they're even, okay? Each of them are different, and they're going to, people have different successes with each of them, depending on their mindset, on how they understand the markets. But for this particular trader, it took 10 to 12 years, basically just losing money. And then, a series of life events took place, and he decided that he wanted to be a trader and he wanted to take this seriously. And one of the things that he wrote down, a bunch of things that he needed to do. One was get a mentor. The other was find a strategy. And one of the strategies, or part of the strategy that he used something called like the magic T, I think it was called. But part of that was using the 10-period moving average to make sure that he is on the right side of the market. Okay, because what happens is most traders fail because they don't limit their losses during the times that they're not right for their trading strategy. And what the power of 10 approach does for us is it ensures that we're on the right side of the market during periods of momentum, because ultimately as traders, we need momentum. We need volatility in order to make money. We don't make money in markets that aren't moving anywhere. All we do is we just churn up brokers' fees and things like that, and we cost ourselves money. So we need the markets to move in order for us to be able to make money, right? So this particular approach transformed legendary market wizard Marty Schwartz from a struggling analyst to one of Wall Street's all-time greats. So get a pen and paper for this part. We're through the theory. I'm now going to start to give you the strategy itself. We use 2 time frames for this. We use a daily time frame and we use a 4-hour time frame. Okay, so the daily and the 4-hour charts. And we're going to apply just one indicator. We're going to apply the 10-period exponential moving average. Now, before I said that you could apply this to your favorite strategy, and you can. Okay, so if the only part you take from this is how to identify the right market to be trading in, that's absolutely fine. You'll just be paying attention to what we do on the daily chart. If you want the entire strategy, then obviously you'll look at what we do at both charts, okay? So the first thing you need is you need the 10-period moving average on your chart, okay? The daily charts and the 4-hour charts. Now, the rules of the strategy are as follows. The first thing that we have to do is we have to identify the market condition. The markets can go up, they can go down, or they can go sideways. And it's our job to figure out exactly what it is that the market's doing. All right. We need to understand the general tide of the markets. Has anybody read the book, Reminiscence of a Stock Operator? Fantastic book. And one of the things that he says in there, and the old fella says, if you remember the book, is, you know, anybody can make money in a rising market, right? If you buy in a rising market or something along those lines. And what he's ultimately saying there is that if you're with the tide, if you're with the overall trend, the overall move of the market, then even if you time things a little bit, you know, incorrectly, you can still make money. So the first thing to do is identify, is the market moving up, down, sideways, you know, what's it doing? The second thing is we then need to wait for the 10-period exponential moving average to trigger. And I'll talk more about the trigger in a second, but basically what it does is that the price trading above the 10-period moving average and closing above there tells us that the market is moving up. So we're looking for buying opportunities. The price moving below it says that the price is moving down, and hence we're looking for selling opportunities. Now, a long time ago, and a few of you might be in this particular situation right now, so it's probably a good idea that I talk about it. When I first started trading, I was looking at the big swings in the market, right? I was looking to trade, you know, the big swings that you will see on a daily or a 4-hour basis, and I was kind of ignoring those periods of time when the markets were just going on a tear. I was like, okay, I'm waiting for the pullback. I'm waiting for the pullback. I'm waiting for the pullback. And by waiting for the pullback, yes, you can make money, but you're also ignoring lots of opportunities to make even more money during the momentum move. And this strategy right here, you kind of have to get your head around it a little bit, but this will allow you to do that, okay? So we then wait for the 10-period exponential moving average to trigger. That is the price trading above it and closing above it means we're looking for buying opportunities. And if it's closing below it, we're looking for selling opportunities. We'll then look for a price action entry. Okay, so now that we understand the general direction of the market, we've been alerted to the fact that price is now trading in that direction, we then want to look for price action to trigger, okay, to allow us to enter the trade. Now, this is where you can insert your favorite strategy. Once you've identified the market condition, and once a 10-period moving average tells you which direction to be trading in, use your favorite entry strategy. Okay, I'm going to show you one here, but use one that you identify with. It really doesn't matter. You already be on the right side of the markets if you do the first two here. So once we get the trigger to trade, then we execute the trade. Okay, so when everything is aligned, we enter the trade, we walk away, we wait for the market to either hit our profit target or hit our stop loss. It's as simple as that. All right. Now, the key, if you can execute this plan consistently, you will make money trading the Forex markets. All right. And actually, any market for that fact. So if you're trading the stock markets, you'll make money trading that as well. The secret, though, is to become proficient in identifying the correct market condition. Okay. And then having the patience to only enter the trade when the price action tells you to. If you can do this, you can achieve a win rate, okay, a strike rate of about 70% with a minimum risk reward ratio of 1-to-1. Right. And that's the key. So let's look at each step in more detail. The first step, the direction. Our first job is to identify which direction the market is moving in. Is it moving up, down, or sideways? If it's moving up, we'll look for opportunities to buy. If it's moving down, we'll be looking for opportunities to sell. Okay, so we'll be looking for our sell trades. And if it's moving sideways, we'll do nothing at all. We'll look for another currency pair, another stock, another commodity, whatever it is. Okay, but the point is that we move on. Now, what is a downtrend? Well, a downtrend is characterized by an ebbing and flowing movement to the downside. The price will start in the top left-hand corner of the chart, and it will finish towards the bottom right-hand corner of the chart. So by the time the price gets to the right-hand corner of the chart, the price should be lower than it was when it began on the left-hand side of the chart. An uptrend is the opposite. So we have an ebbing and flowing movement to the upside. The price will start in the bottom left-hand corner, and it will finish in the top right-hand corner of the chart, okay? Yes, there will be moves to the downside, but the general direction of the market will be up. Finally, sideways price action is characterized by the fact that really there's no general direction. The market moves up a little bit, it moves down a little bit, but the price change from the left to the right of the chart shows very, very little change. It hasn't really done very much at all. All right, so that's the first thing. We identify the direction. The next thing is we want to wait for momentum. Remember I said that we as traders will make money when the market is moving. So we have to wait for momentum to give us the best chance of doing that. So once we found direction, we then need to wait for something to tell us when momentum's there, because momentum is a bit abstract, right? It's not something that you can necessarily, or particularly for a new trader, it's not something that you can pick out easily. So for this, we use the 10-period moving average. Now, if price is above the moving average in an uptrend, then we know that we will likely make money if we find a buy trade. If price is below the moving average in a downtrend, then we know that we probably have a good chance of making money if we find a sell trade. It's really as simple as that, okay? Now, what I want you to do here is kind of look at how price moves when it trades above the 10-period moving average, okay? I want you to see that regardless of where you would have bought on this chart, okay, so if we would have bought here, or bought here, or bought here, or bought here, the market moves up and we would have made money, if obviously we have the right risk management in place. So if we're not strangling our trades or anything like that, but in an uptrend, when the market trades above the moving average, okay, then more or less wherever you buy, forgetting price action for a second, forgetting the entry, you buy anywhere and the market moves up the next day. Okay, it's only 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 occasions on this whole chart here. And how many candles were there? There's 1, 2, 3. Well, I'm not going to count them all, but there's quite a few different price action candles on this chart here. And ultimately, you'll see that only in a few very small cases, the market would have traded against you. And even if it did, it wouldn't have done so by very much. The candles going against you are very small. Okay, they're not big bodied candles. The trades that go for you, you've got nice big momentum candles. All right. Okay. So now the entry. Now that we've done all the hard work, we've identified the overall trend. We've highlighted a period where price is moving in the direction of the trend with momentum. Now it's time to drill down and find out exactly, where is it that we want to enter the trade. And this is where you can insert your favorite strategy or follow what I'm about to show you here. Okay. So the way that I do it is I will use either a 4-hour or sometimes an 8-hour chart, all right, to basically identify where it is that I want to get involved in the markets. And what I'm looking for is a very simple price action entry, and that is a temporary pause in the markets, okay? So what I'm looking for is momentum. So we get momentum here, and then I want a pause in price action. So I want the price to move sideways. I don't want it to pull back. Remember, I'm not looking for the swings here. I'm looking for gentle pauses in the momentum, and then I'm going to sell the breaks of those highs or lows. And look at what happens when you get this right. When you get a market that's trending in the right direction, I say right, well, so whether it's trending to the upside or the downside, and then you find the period of momentum. And then once you got the period of momentum, this was a down period of momentum here, you then wait for the pauses in price action, and then you get the break. Then it moves sideways, and you get the break. And it moves sideways, and you get the break. Now, some of you, the day traders out there, will be looking at this thinking, yeah, but I want to be in and out of the markets many times a day. I want the quantity, I want the volume of trades. Well, just take a look at the periods of consolidation. Look at this here. So we get momentum. What is that? It's a doji, a couple of spinning tops. Not really too much of a range there. So even if you were trying to day trade during this period, it would have cost you money. How many day traders out there? Right, just think to yourself here for a moment. How many day traders out there spend, 2 to 3 days of their week just kind of hovering around break even, trading water, making a little bit, losing a little bit, making a little bit, losing a little bit, and then they get those big momentum days and they make money? How many of you are out there doing that? Right? Well, save yourself time. Don't bother with those days where it's moving sideways. Take a little bit of a step back from your trading. Don't day trade. Take a longer term view from your trading, and actually just say, during these times when the market's moving sideways, complete crap, probably wouldn't have made money anyway. I'm just going to stay away. And I'm going to have orders in. So I don't even need to be near my screen. When the market breaks a low, I'm going to sell with an order, have my stop above the high, and then wait for the market to go to 1-to-1. You make money, you make money, you make money, you make money. You might have been stopped out there, but then it breaks down again, you make money. And during these downward periods, most of the time, you'll come out ahead of the game. Who would prefer to be in that situation rather than wasting 3 or 4 days of a 5-day week hovering around break even, doing nothing but churning up fees, okay, when actually you could just wait, put some orders in and make the same amount of money. This is what this approach will do for you. Now, stops and targets. It's our traders, as a traders, it's our responsibility to protect our accounts, which means we have to exit our trades at the first sign of danger. Now, stop loss is placed just above the high for a sell trade and the low for a buy trade. And in the beginning, from a take profit perspective, I don't want you to do anything too clever. I just want you to use a one-to-one reward to risk ratio. So if the stop is placed 100 pips away, our take profits will also be placed 100 pips away. And if you can do that, keep it simple, stupid, you will be on the road to actually finally making some money from your trading. Okay, so let's go through an example. Direction. Looking at this chart, okay, we can see that the Aussie dollar is trending downwards on the daily chart, okay, indicating that our best chance of success would be a sell trade when price moves in the direction of the overall trend. Okay, so we don't necessarily want to be buying. You could buy when the market trades above the 10-period moving average, but we've got a better chance of success, and we're going to have better moves if we trade when the market is moving in the direction of the overall trend. All right, so the Aussie dollar there is moving to the downside from the top left to the bottom right-hand corner of the screen. Then we wait for momentum. We can see on the right-hand side of the chart here that the candle closes below the 10-period exponential moving average, indicating that now would be a great time to look for short opportunities on the 4-hour chart. We jump down to the 4-hour charts, and we can see there, everywhere where I've highlighted in green, we've had the momentum. The market's trading beneath the 10-period moving average, and all of those trades end up giving us a profit. And I'm not trying to say that you'll never have a loss. Obviously, when you're doing these things, you're doing these webinars, you want to show the people the best case of everything. There will be losses there. Absolutely, there will be losses. But you'll have a far higher ratio of win trades than you will loss trades. Okay? So there are your entries for you. So let's go back. Direction, moving down. Momentum, breaks to the downside below the 10-period moving average. When it breaks down, we then look for sell trades after pauses in momentum in the charts. Okay, that's all you have to do. I say all you have to do. I understand that it's going to be more complicated than that, but I promise you, if you can do this, that you are going to put yourselves on the right side of the markets, and you are going to put yourselves in a great position to make money in the long run, which ultimately is what you all want to do, right? You all want to make money. Now, it's not the sexiest system out there. I don't have 400 different indicators on my chart, but I'll tell you what, it's a very, very profitable one. It's a very, very consistent one. And I urge you all to give it a go, okay? Exits obviously go above the highs, as I told you. So if we're selling the market, it goes above the highs. If we're buying the market, it goes below the lows. It's as simple as that. It doesn't need to be more complicated. So if we go over the rules again very quickly for you, 4 very, very simple steps. 1, identify the market conditions. It can go up, down, or sideways. Our first job is to figure out exactly what is it that the market's doing. Once we understand the general tide of the market, we can then wait for momentum. The second step, wait for momentum. Wait for the 10-period EMA to trigger our trade. The third step, look for a price action entry. And the fourth step, execute. Execute, execute, execute according to your plan. Don't manage it once you're in the trade. Definitely don't manage it when you're first starting out. Just get into the trade, put all of your orders in, walk away. Either your stop's going to get hit or your target's going to get hit. And if you follow these rules right here, then you should put yourself in a position where your target is going to get hit more than your stop will get hit. Does that make sense to everybody? Are there any questions? So Simon, I'll let you I can't read properly what's on my screen here, so I'll let you sort of browse through the questions if there are any.
Yeah, sure, Alex. So there might be some questions just coming in. Now, great simple strategy, says Clemens. Absolutely. Sijal says, how will you determine profit booking point?
So as I said in the beginning, let's just keep things simple, and it's equal to 1 times your risk. So if our stop is 100 pips away, the stop is obviously defined by going above the high in a sell trade or below the low in a buy trade, then your take profit will just be 100 pips. Let's just go for 1-to-1 to start with.
Richard says, is a close necessary for an entry, i.e. wait for candle to complete?
No, because what you find is that if you're taking trades with, during periods of momentum, by the time you wait for the close, your risk to reward will be a little bit skewed, and you'll find that you'll suddenly start to have a much higher loss ratio. What I do wait for, though, is I'm not waiting for 1 or 2 pips. Typically, I wait for about 5 pips, 5, 6 pips below the low of a candle for a sell trade or above the high of the candle for a buy trade.
Okay, Sujal again, do you wait for the close of that period to hit your stop loss?
No, again, we're not waiting for closes here. We're literally just waiting for price. Whilst you're going through the questions, I should talk to people about very quickly about the price action trading club. Is that okay?
That would be great. Yes, there's more questions coming in. So, but let's take a break from questions, and where do we go? Yeah.
Okay, guys. Well, whilst you're typing in your questions there, obviously we do these things. We want to give you guys opportunities and offers to work with us. We don't do everything from the kindness of our hearts, although we do try. So what I want to talk to you very, very quickly about is how you can work with me. And there are 2 primary ways that you can do that, okay? The first is a blank screen. So that's a fantastic example of copy and paste going on here. But basically, there are 2 things. We've got the price action trading club, and we've got the price action trading course. All right, let me try and get to these. Okay, both blank screens. This is an excellent example here of me not being able to see when I'm doing these slides for you. But basically, okay, we've got the 2. So the one is the course, which would kind of take you into more detail about the things that I've shown you on this webinar here. So here I've shown you how you can enter on a break of a pause in a momentum move, but then we talk more about how you buy from support, sell from resistance, and really just understand what's going on generally in the market. So rather than taking a strategy and say, trade this strategy just because I'm telling you to trade this strategy, we go into understanding why the markets do what they do. Okay, so if a market is approaching a resistance point and it prints a particular candlestick pattern, don't just sell because the candlestick pattern's there, but actually sell because you understand what the candlestick pattern is telling you, right? Because when you're trading price action, you'll find that the charts, okay, they all tell you a story. Everything tells you a story. It's not just this is a shooting star, so sell, or this is a hammer bottom, so buy, or anything like that. It's the fact that the market's traded up to this point. It's broken through this point. When it breaks through this point, you're expecting momentum. There was no momentum. The market closes back beneath this point, which is indicating that actually the sellers were perhaps in control here. We have a little bit of a liquidity fade going on here. And if the market then breaks the low of the candle, here's a great opportunity to sell. You see what I mean? So this is what the price action trading course basically takes you through. If you're more advanced than that, so if you understand how to trade all of this stuff and you don't really need the tuition, but rather you need a bit of guidance in terms of, this is the right thing to look at, or you want to see what it is that I'm looking at, then I have something called the Price Action Trading Club, where I will ultimately walk you through the trades that I'm taking along with the rest of the community. So you can contribute as well. It's kind of like one big virtual trading desk where we all to get together and we trade the market. So I'll post what I'm trading. I'll say why I'm trading it, what I'm looking at in advance. So you can kind of learn on the job, so to speak. You can confirm that what you're seeing in the markets is what I'm seeing in the markets, and hopefully they both align, and hence you can make money trading in that way. Okay, so we've got 2. We've got the price action trading course and the price action trading club. What I will do is I will try and type the link into the chat box here. Otherwise, I'll let Simon circulate it for you, or you can drop me an email at tradedesk@tradeforaliving.co.uk. Okay, and with that, we can go back to questions.
Great, Alex. You're going to put the link into the chat box there for me.
Yeah, if I can actually, apparently I can't type anything in there. So, hold on. Okay, you guys go ahead and I'll find a way. I just can't see anything.
All I need to do, I'm just going to make you organizer, and then you'll see all the questions, and then you'll have direct access to that.
Okay, that's cool. Yeah, so any other questions, guys?
Yeah, there was, how do you determine which is the right stock to use with this strategy?
How do you determine? So as I said, it's basically you're going to put it above. So if you're looking at a sell trade, you put it above the highs. If you're looking at a buy trade, you put it below the lows. Ultimately, what you're trying to do with every different type of trading strategy is you want to be out of the markets as soon as you know you're wrong. Okay, you don't need to be in the markets much longer than that. So as soon as the markets kind of tell you that you're wrong, which is indicated by a high or a low being broken, then you want to be out of the markets. Does that make sense?
Yes, I think, yeah, Sejal, if that's making sense, to just let us know that that's answering
The
your
link is in the
question.
chat box as well now, guys, so you can go take a look at that.
Great. Richard says only the majors in FX and crosses traded.
No, you can actually apply this strategy to literally anything that you can display a chart on. So I use this on stocks as well. It's not my whole stock trading process. What I'll also do is I'll use sort of like a global macro approach to narrow down the stocks, but then I'll use this from a technical perspective to actually trigger my entries.
And what about negative gaps? Richard is asking.
Negative gaps in the stock market.
How do you handle negative gaps?
You just have to swallow them. I'm not somebody that waits for, a gap to be closed or anything like that, because oftentimes the market can just keep going against you. So, if you are unfortunate enough to suffer from that, you just have to take the loss, I'm afraid.
Yeah, weekends, etc. Richard is saying so.
Yeah, although you don't get that many gaps. I mean, not major gaps nowadays. And one of the things I would say, Richard, is that I don't mind holding positions over the weekend, but I don't tend to enter positions on a Friday afternoon. So past midday, the positions are the ones that are on. I don't enter anything new.
Okay, fantastic. Any other questions for Alex? You make it sound so, I think, so simple and so straightforward. There's no questions. It all makes sense, says Richard. There we are. So that's great
Excellent.
news. So we're making sense. Fabulous. Okay, Alex. Thank you very much for joining us. I hadn't realised you were recovering from eye surgery, but I hope everything comes into focus in the next few days for you. Boom, boom.
Like it. I
And
do too.
we will continue to speak. We've got these links as well. We can share these links to everybody in the room. There's your email address. People want to contact you as well, which is fantastic. But thank you very much again for coming in. One more question, maybe from Tony first
Yep.
before we let you go. Do you have a live chart example shown? I don't think we do have.
I can do. I mean, if we have a moment, I don't know. I can't actually see the time, so I don't know how much time we have.
Well, we've got the time. If you do, it's just some.
Okay. If you take a look at the pound Aussie here, all right. So with the pound Aussie, one of the things that I do is look at another period of moving average, so 100 period moving average, to also identify early signs of momentum. So we can see here that we get a structure break, all right, to the downside, a bit of a head and shoulders reversal going on over here. Let me zoom in a little bit on the daily chart. Okay. So let's say from around the 24th of April, the market was moving to the downside. So we're looking for opportunities to sell. If we then take a look at the 4-hour chart here, you can see, what did I say, 24th of April. So let's zoom in here for a second. The market breaks to the downside. So we're looking, that's not the 24th, here's the 24th. So here the market breaks down. You can see that we get momentum, you get a slight pause. We could have sold beneath here. The market sells down a little bit more, moves sideways a little bit, and then we sell the lows again. Over here, we don't get the opportunity to sell because we don't get the pause. The market pulls back a little bit. So we're not looking for any opportunities to get involved in the market. You see that we don't buy here because we're looking for sell opportunities. The market then breaks back below the moving average over here on the, what is that? Is that 6th? Yeah, that's the 6th of May. So let's look at the 6th of May on the charts here. Whoops, can't see my cursor properly. Somewhere around here. So the market breaks down, it moves sideways a little bit. You get the break of the low. I actually don't like this one because you get too much of a pause followed by a bit of momentum to the upside. So even though that would have made money, that's not one that I was involved in. But then you can see that now the market starts to move down. You get a break of those lows there. You can sell that. You would have got stopped out here. And the market continues to move down. You get a break of this low here. You can sell. You'd make some money. Break here. You'd make some money. And then obviously the market starts pulling back a little bit. And when it pulls back, we get momentum to the upside. So we wouldn't be involved in those markets anyway. Does that make sense?
I think it does. Thank you for that. Tony, does that help? Yes, he says yes. Fantastic. Okay, well, thank you very much, Alex.
You are most welcome.
Could this work for a longer term hold?
No problem. Sorry, what? Yeah. Could this work? What? Sorry.
Yeah, that was Dan. Dan, are you there? That's Dan.
Yes, I am. Brilliant presentation. Thanks, Alex. Yeah, I saw that you're one of the other speakers on FX Street too. I think you're coming up around about my next webinar. So yeah, great to hear your presentation. Yeah. Thanks for joining us today, and really enjoyed that.
No problem at all. Yeah, I've been on FX Street for 10, 12 years now, so I get around.
Yeah, in a while, yeah.
But yeah, excellent. Well, thank you for having me, everybody. Really kind of appreciate you having me on board here. It's always a pleasure, never a chore. And everybody, good luck with everything that you're doing. I know that obviously it's tough trading these markets and things. So whatever Simon or Dan or I can do to help, I hope it has helped you. And as I said, good luck in all of your endeavors. It's very, very possible. Just put in the effort.